In today's video, we're diving into 3 top-performing stock split stocks that may be on the verge of a significant downturn. But before we get started, let me ask you this. Would you rather be prepared for a potential market shift or caught off guard when it happens? Understanding the risks and rewards of these stocks could make all the difference in your investment strategy. So stick around, because we're not just talking about what's happening now. We're also giving you actionable tips on how to navigate the potential market changes ahead. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. Stock splits have long been a fascinating topic on Wall Street, drawing considerable attention from both seasoned investors and newcomers alike. A stock split occurs when a publicly traded company decides to alter its share price and outstanding share count by the same magnitude. This maneuver is purely cosmetic in nature. It doesn't impact the company's market cap or its fundamental operating performance. Essentially, a stock split is akin to cutting a pizza into more slices. It doesn't change the size of the pizza, just the number of pieces. Stock splits come in 2 flavors: forward and reverse. A forward stock split is typically undertaken to make a company's shares more affordable to retail investors, especially those who might not have access to fractional shares. This kind of split usually signals strength, as companies often choose to split their stock when the share price has risen substantially. On the flip side, a reverse stock split happens when a company increases its share price by reducing the number of shares outstanding. This is often done to avoid delisting from major exchanges, which have minimum price requirements. Forward splits generally attract more investor interest because they suggest confidence and growth, whereas reverse splits can sometimes be seen as a red flag. In the past 6 months, we've witnessed 12 major companies either announce or complete a stock split. Of these, only 1 was a reverse split, indicating that the majority of these companies are riding high on strong performance. However, not all of these stocks are expected to continue climbing. In fact, some Wall Street analysts are warning that 3 of these stocks could see substantial declines, with predictions of drops as severe as 98%. Let's start with NVIDIA, ticker NVDA, a company that has been at the forefront of the AI revolution. NVIDIA is widely recognized for its cutting-edge graphics processing units, GPUs, which have become essential components in AI applications. The company completed a 10-for-1 forward stock split recently, reflecting its strong performance and high market valuation. However, despite its current success, there are voices on Wall Street, like that of financial writer Harry Dent, who predict a stark downturn for NVIDIA. Dent has warned that the current market bubble, which he believes has been inflated by government stimulus and has lasted an unusually long 14 years, could burst, sending the S&P 500 down by as much as 86%. He specifically mentions NVIDIA as a stock that could collapse by 98%, although this outlook is particularly dire and not widely shared. While Dent's forecast may seem overly pessimistic, it's worth considering the historical trends he references. Wall Street has seen many hype technologies. Think of the dot-com bubble or the clean energy surge that initially soared but eventually faced significant corrections. AI, being a relatively new and rapidly evolving field, may be following a similar trajectory. Investors often get caught up in the excitement of new technology, overestimating its immediate impact and underestimating the time it takes for the technology to mature and become profitable. Currently, many companies are still figuring out how to effectively integrate AI into their business models, which means the expected financial returns may take longer to materialize than the market anticipates. But before we proceed, here's a quick question. What's the most surprising stock movement you've seen recently? Share your thoughts in the comments below. NVIDIA faces another challenge: competition. Although it's a leader in AI GPUs, the demand for these processors far outstrips its ability to supply them. This gap opens the door for competitors to step in and capture market share. Furthermore, some of NVIDIA's biggest customers are developing their own AI chips, which could reduce NVIDIA's market dominance over time. As a result, NVIDIA's impressive profit margins and pricing power may have already peaked, which could spell trouble for its stock price in the future. Next, let's discuss MicroStrategy, ticker MSTR, another stock split candidate that has been on a remarkable run but might be headed for a fall. MicroStrategy is primarily a software company specializing in enterprise analytics, but it has gained notoriety for its massive investment in Bitcoin. The company recently executed a 10-for-1 forward stock split, and its stock has skyrocketed, driven largely by the rising value of its Bitcoin holdings. However, some analysts, such as Brent Thill from Jefferies, are skeptical of MicroStrategy's current valuation. Thill has placed an underperform rating on the stock, with a price target of $210, which represents an 87% drop from its current levels. The primary concern here is the way MicroStrategy's market cap is heavily tied to Bitcoin's price. As of the latest reports, MicroStrategy holds over 226,000 Bitcoins, valued at more than $14 billion. But here's the kicker. Investors buying MicroStrategy shares are effectively paying a premium of nearly double the current market price of Bitcoin. Instead of purchasing Bitcoin directly at its market price, investors are paying a significantly inflated price through MicroStrategy shares. This premium might be justified if Bitcoin were expected to continue its upward trajectory indefinitely, but cryptocurrencies are known for their volatility. Bitcoin has experienced numerous boom and bust cycles, and if another severe downturn occurs, MicroStrategy's stock could be hit hard. Additionally, MicroStrategy has financed its Bitcoin purchases through convertible debt offerings. This strategy works well in a bull market, but if the cryptocurrency market takes a dive, the company could find itself in a precarious financial position. Adding to the uncertainty, Bitcoin's first-mover advantages are fading, as other cryptocurrencies and blockchain technologies offer faster and cheaper transaction alternatives. All these factors combined make MicroStrategy a risky bet at its current valuation. The third stock on our list is Cintas, ticker CADAS, a company that specializes in providing corporate identity uniforms and related services. Cintas is a well-established player in its field and has seen consistent growth, which led it to announce a 4-for-1 forward stock split recently. However, not all analysts are optimistic about its future prospects. Leo Carrington from Citigroup, for example, has issued a sell rating on Cintas with a price target of $590, suggesting a potential downside of 23%. Carrington's bearish outlook is rooted in the belief that Cintas is already trading at a premium valuation that may not be sustainable. Cintas is what's known as a cyclical business. Its performance is closely tied to the broader economy. When the economy is strong, demand for corporate uniforms and related services tends to rise. But during downturns, this demand can fall sharply. Several economic indicators, such as the decline in US M2 money supply and the prolonged yield curve inversion, suggest that the US economy may be heading toward a recession. If this happens, companies like Cintas, which are priced for perfection, could see their stock prices fall as earnings expectations are adjusted downward. Valuation is another concern. Cintas is currently trading at nearly 46 times its expected earnings for fiscal 2025, a multiple that is high even for a company with strong growth prospects. Although Cintas has benefited from acquisitions and operational efficiencies, its organic growth rate of 7.5% may not be enough to justify such a lofty price-to-earnings ratio. However, unlike NVIDIA and MicroStrategy, Cintas has a robust capital return program, including a recent 15.6% increase in its quarterly dividend and a $1 billion share repurchase plan. These factors could provide some cushion for the stock, making a dramatic decline less likely. As shown in the chart, NVIDIA, MicroStrategy, and Cintas have experienced notable price changes recently. NVIDIA, trading at $98.91, has dropped by 5.12%. while MicroStrategy has taken a steep fall of 8.94%, now priced at $1,246.85. Cintas, on the other hand, has seen a smaller decline of 0.70%, trading at $740.19. These fluctuations highlight the volatility in the market, especially for AI-driven stocks like NVIDIA and MicroStrategy. With NVIDIA's gross margin at 75.29%, and Cintas at 47.16%, investors need to consider these financial metrics along with market movements to make informed decisions. Despite the challenges, Cintas offers a dividend yield of 0.73%, adding another layer of consideration for potential investors. In conclusion, while stock splits can create excitement and often lead to short-term gains, it's important to remember that they don't change the fundamental value of a company. NVIDIA, MicroStrategy, and Cintas have all benefited from stock splits, but they each face unique challenges that could lead to significant price declines in the future. NVIDIA's reliance on AI, MicroStrategy's dependence on Bitcoin, and Cintas's high valuation in a potentially weakening economy are all factors that investors should carefully consider before jumping in. But before we wrap up, here's something to ponder. What strategies do you think will help investors stay ahead of the curve? Drop your thoughts in the comments below. As always, we encourage our viewers to do their own research and consult with a financial advisor before making any investment decisions. Thank you for watching Simple Investing Secrets. If you found this video helpful, please like, share, and subscribe to our channel for more content that can help you on your journey to financial freedom. Remember, This video is for informational purposes only and is not financial advice. We'll see you in the next video.